I would like to highlight how to use economic indicators to time your stock market investments. How to use economic indicators to time stock market investments. So I want to consider number one, introduction to economic indicators. So economic indicators are metrics that offer insight into the health of the economy. These metrics, will give an insight into how healthy or otherwise the economy is. So it highlights their relevance for investors, particularly in predicting market trends. These factors are relevant for investors to be able to know how to predict, future trends in the markets. So we need to, differentiate between leading indicators that predict future trends and lagging indicators. These ones confirm trends. Leading indicators predict future trends, while lagging indicators confirm, existing trends. And then there's coincident indicators. It reflects current conditions. It reflects, current conditions. Lagging indicators, confirm, uh, the existence of trends. Number two, key leading indicators. Key leading indicators. We have gross domestic product. GDP is a leading indicator. So it signals the overall health of the economy. Example, a rising GDP will then align with a bull market, and a declining GDP will then trigger, a bear market. So you also consider consumer confidence index. Consumer confidence index. So it tracks, consumer sentiments about the economy. It tracks consumer sentiments about the health of the economy. So higher confidence typically signal, increased spending, benefiting, consumer-focused stocks. We have the Purchasing Managers Index. Purchasing Managers Index. So it tracks, manufacturing and service activities. So the PMI above 50 signifies economic expansion, whereas PMI below 50, indicates economic contraction. So example, a rising PMI could indicate strong demands for industrial, or material stocks. Then you have unemployment rates. Unemployment rate is a key, leading indicator. So a decrease in unemployment rates, suggests economic growth, but rapid decline may hint on overheating. So sectors sensitive to employment trend, include retail and housing. So this and the retail sector and the housing sectors are kind of sensitive to employment trends. Number three is lagging and coincident indicators. We've just considered leading indicators. I want to look at lagging and coincident indicator. A typical lagging indicator is inflation. Inflation is inflation. So in this case, you consider consumer price index. So high inflation may erode purchasing power, which will then mount pressure on growth stocks. Once consumer can no longer purchase as expected, can no longer spend as expected, that will impact growth stocks negatively. So defensive stocks like utilities or consumer staples, often performs better during high inflation because their services are always in high demand. Even in an inflationary environment, it doesn't really change significantly. Then we'll consider interest rate. Interest rate is a key, lagging or coincident indicator. Interest rate. Central banks, rate hikes often signal inflation control, but can weigh on borrowing intensive sectors like real estates. Whenever the central bank comes in to either cut or hike interest rates, it would affect relevant sectors significantly. So lower rates, usually benefit growth stocks and the broader markets. Let's look at corporate profit. Corporate profit is also an indicator. It's a lagging indicator. So coincident with stock performance, rising profit may indicate favorable conditions for equity market. Whenever there's rising profit and earnings, then it will lead to a bull market. Please like this video and subscribe to this channel. Number 4 is using indicators for investment timing. Using indicators for investment timing. So there's an economic expansion. Focus on growth stocks or growth sectors like technology, consumer discretionary, as well as industrial. Whenever there's economic expansion, you focus on these industries. So in an event of economic contraction, you shift to defensive sectors like healthcare, like utilities, as well as some government bonds. Then in a recovery period, in recession recovery, you consider cyclical sectors like travel and leisure as the economy rebounds. Number 5, tools and resources. So what are the relevant tools and resources you could use to track these indicators? So you may use websites like Yahoo Finance, Trading Economics, and official government portals like the U.S. Bureau of Economic Analysis. These are where you get data that indicates the presence of these indicators and how you could analyze them. So you also use economic calendars to track upcoming indicator releases. You may also employ apps that aggregate economic data for analysis. Number 6, risk and challenges. There's that risk of false signals. Leading indicators may misrepresent future trend. It may not really yield to an accurate outcome in the future, but sometimes it may be unreliable. It may misrepresent future trends. There's also the risk of overreaction. Market often price in expectation before indicators are published. People tend to be proactive, and as a result may overreact. Then in conclusion, start by tracking a few key indicators to avoid information overload. Don't track too much. Don't consider too much at a time. Just track key relevant ones and then you may expand to incorporating other indicators into the mix. Pair economic insight with your risk tolerance and investment goals. Not only that, stay updated and flexible as economic conditions can shift rapidly. So it can shift rapidly. So stay flexible and then stay updated.